How do you choose hedging strategies for commodity markets? Imagine you're holding a bag of your favorite snacks, and suddenly the price starts to jump up or down. You want to protect yourself from those swings, right? That's what hedging is all about in commodity markets. But how do you pick the right way to do it? It all depends on understanding your specific risks, your business needs, and what kind of commodity you're dealing with. First, you need to figure out your exposure. Are you buying or selling the commodity? If you're a manufacturer worried about raw material costs rising, you are a buy-side hedger. If you're a producer worried about falling prices, you're a sell-side hedger. Next, look at how much and when you need the commodity. If you plan to buy or sell in the next 3 months, your hedge should match that timeline. Now think about the tools available. Futures contracts are popular because they are traded on exchanges, so they are easy to buy and sell, and they offer a set price for a future date. For example, if you know you'll need 10,000 barrels of oil in 6 months, you can lock in a price now with a futures contract. Forward contracts are similar but customized. They are negotiated directly with a supplier or buyer, which can be useful if you need specific delivery terms. Options are another choice. They give you the right, but not the obligation, to buy or sell at a certain price. This flexibility helps if you want protection against price increases but still want a benefit if prices fall. For example, a farmer might buy put options to sell their crop at a guaranteed price, protecting against a price drop. Physical hedging involves locking in prices directly with suppliers or customers, which can reduce financial risk but might involve credit risks or less flexibility. Timing and risk tolerance also matter. Tracker hedging involves gradually building or reducing your hedge as the delivery date gets closer. This way, you can adjust your position based on new market information. Delta hedging is more advanced and involves continuously adjusting your options positions to stay neutral to price movements. Risk reversal strategies combine options to create a directional bet with limited risk, useful if you expect prices to move strongly in one direction. When choosing your strategy, consider practical factors. Credit risk is important. Regulated exchanges reduce this risk compared to over-the-counter contracts. Flexibility is key. Futures and options can be unwound or changed if market conditions shift. Cost is another factor. Transactions and margin requirements can add up, so weigh these against the benefits of risk reduction. Market liquidity matters too. You want to be able to buy or sell your hedge without trouble. Most companies don't rely on just one approach. They often layer different strategies, like combining futures with physical contracts or mixing various maturities. For example, a food producer might lock in part of their grain needs with futures while leaving some open to benefit from potential price drops. In the end, choosing a hedging strategy is about matching your exposure, risk appetite, and business goals. Use the right instruments at the right times to keep your prices stable and your business protected from unpredictable swings.